Now, we did say that a forward contract is an instrument that has life. So it must have a start and an end. So we said today, the value today is given by a value of 0, or some would say now, right? At the end of the contract, this value time t is maturity, correct? And then we said we can be able to establish a value, or when we liken it to an investment that we take. And the assumption we gave in our prior classes was that you invest not to gain an arbitrage profit, because the securities are well priced. So investors and lenders, that is borrowers and lenders, transact at the risk-free rate. So also on that, we said that anytime after the initiation of the contract, parties may be desirous to know what value does the contract have. Value in the sense that what parties who hold a particular transaction in an underlying instrument will like to be either paid or pay to get off that contract. So that price in between before maturity is an arbitrary time we would call T. So in the general pricing and valuation, so at initiation, we find out that the value today for a contract that is established now that matures in T time is given what? Is given by the SO, which is the price today, minus the future value of the contract that is established today that matures in T time, divided by 1 plus the risk-free rate, right, and T. This is where we said we remember that the future value of a contract that is started today that matures in T time is, for example, that you want to invest your SO today times 1 plus the risk-free rate, investing that money to earn the risk-free rate, and T. So this is borrowed from our general investment formula, where we said the future value of a contract is given by the present value of a certain investment times 1 plus r raised to power n. So this formula here is more what you are doing in your previous classes, where discounting and forward calculator on the future prices is concerned. So that is how we get the valuation. And at any particular time today, what you would receive in future, you discount it. Yeah, by this element is discounting to be able to get the present value today. Now, after passage of any time, after passage on any time, we get after time, say small t, right? We can get the value given as VT for any contract established now that matures in time t, to be given as that particular price of that asset minus the future value of that contract, discounting it at the risk-free rate, and now T minus t. So this is at a value t here. So at t here, we will receive, or we will check the market and see what other investors are desirous of buying the underlying instrument, may it be a share or any other instrument. Now, the value here will be given. Remember, there is a future commitment either to buy or sell at maturity, correct? Now, when we discount that future obligation either to buy or sell, this is why we say we minus, then discounting by the period between t, capital T, and a certain arbitrary time t. Now this period is known as t minus t. Yeah, it's known as t minus t. That's how we value a forward contract at any time after initiation. Now, remember that at initiation also there is no money that changes hands. So this investment also holds. So no money changes hands. No money changes hands. Now, at expiration, this is what we also called maturity. At maturity, we find that now the value of a contract maturing at T that was initiated at time 0 and matures in T is given by, at expiration also, investors do check what is the value of the underlying asset. So the value of underlying asset, so minus any future commitment that was initiated at the beginning that was to mature at time T. Now, remember, at expiration is maturity here now. So the time that at maturity will be now, there will be no need to discount. The future value will be that value.